Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to be giving you some information suggested by one of our viewers who wrote to me, Jay Malik. Appreciate you, Jay. Suggested that I make some content about basically tax planning for people who are trading stocks. And I've touched a little bit on this in previous videos, but I'm going to touch really specifically on how it applies to kind of like maybe how that type of person's decisions will be quite different from a lot of other people's, and what that might mean about where you would go and things like this that, again, I think are a little bit different than where a lot of other people would go. So stick around for that. I'm going to kind of give you some feedback on what I would suggest if you were in that position. And yeah, we're going to dive into it. Before we do that, if you haven't already, please hit the subscribe button, nail the notification bell, make sure you don't miss out on any of our future videos. I try to produce great content for you every single day. We really appreciate your support, appreciate your subscription. We're trying to grow the channel, produce great content. And if you want help with any of these things, international structuring, either living, like kind of for you personally or for your business, in terms of figuring out the right solution or implementing it, happy to help you with any of those things: residencies, citizenships, opening bank accounts, forming companies, payment processing, etc. Reach out to me. You can book a call, calendly.com/Michael-Rosmer, or you can check out our websites, offshorecitizen.net, offshorecapitalist.com, and you can send us a message through there. Okay. So here's the deal. I've talked over the last little while a little bit about trading, because I've had quite a few people who are day traders who have contacted me, or people who are trading crypto who have contacted me. I've discussed a little bit about the tax rules in one place or another. And the bottom line is that trading income is pretty much always considered earned income, okay? And usually what I'm seeing when I deal with clients is most of the time it's one of two things. Either they have high business income, right? Meaning maybe they have an Amazon store, or you're an affiliate, or you're doing something with an FBA business, or maybe you own a bunch of McDonald's franchises or whatever, right? But you have a business, and that business is earning a bunch of profit. Or you have a bunch of investments. Maybe you've bought a bunch of crypto and you've been holding it for a bunch of time, and that's making a bunch of money. And usually in this scenario here, there's special planning you can do. There's places that you can go where you can get better treatment for dividends or for capital gains, etc. So that's one strategy. And then the other one is we can say, okay, we can optimize the business maybe separately from you. So for example, I've talked a lot, I've kind of gone country by country doing various profiles. Places like UK was one of the recent ones I covered. And so maybe when you take it personally, you're going to pay a bunch of tax, but you could get the corporate side of the tax down to potentially close to zero, right? Same is true in Canada, same is true in a bunch of different areas, okay? And so as a result, you're like, all right, well, that's maybe workable. But when you're talking about a trader, you don't get to take advantage typically, not always, but typically, of the capital gains rates. Usually that's active income because you're turning the portfolio frequently. And I'm going to talk in a minute about how do you define what's a trade or what's not. But that's one. And at the same time, you don't have it in a business because it's you who's doing the work, right? You don't have employees, you don't have whatever. And so that can be an issue, right? So what do you do in this case? So first of all, what is a trader? Well, traders, I would say, are generally defined by three characteristics mainly. Number one is how many trades are you doing? Or how many transactions are you doing, right? If you're doing a lot of transactions, then that's being a sign of a trader versus an investor, right? Number two is how long do you hold for, right? There's kind of a stereotypical rule of thumb of holding for a year. Now the truth is that some countries have a hard and fast rule of saying, okay, if you held for a year, it's a long-term capital gain. If you hold for less than a year, it's a short-term capital gain, this kind of thing. A lot of countries don't have that distinction. Some places it's kind of a loose idea that, okay, generally speaking, if you're buying stocks or real estate or something like that, it's generally long-term, but they may come and recharacterize it if they see you're doing a lot of churn, right? The third thing is, I would say, how much time you're putting in. Like, do you treat it as a job, right? If you treat it as a job, then you're probably a trader as opposed to an investor. Not necessarily, but perhaps, right? So those are the main things. And obviously the factor that causes them to look is, how much money are you taking out? So I was having a conversation with somebody recently about Portugal. And, if you're in a situation where you're pulling out a lot of money, you're, buying expensive cars and houses, you're attracting more attention. Okay, that's going to draw more attention to you. It's going to cause more issues, okay? So if you're in that situation, what do you do? Well, sometimes you actually can operate through a local business. Okay, so what would you do? You'd form a local company. The local company, you would trade through it. You would pay a lower tax rate, and you would defer. So a good example of this might be someplace like UK, right? The corporate tax rate. So basically, it's just based on the fact that corporate tax rates are typically quite a bit lower than personal tax rates. And so if you're going to just keep churning over and over again, you may end up in a better situation if you form a local company and you do that. Now, in some places, you don't gain that benefit, or they penalize you for doing those types of activities within a company or things like this. But sometimes that's workable, okay? On the flip side, where you may want to move could be different. So let's talk about, for instance, we talk a lot here about Portugal, right? So Portugal can be a great place to go, but if you're a trader, it's not really a great place to go unless you have enough scale that you can basically build a team and set up things abroad, or you're traveling a lot and you can trade while you travel, or things like this. Things that it's questionable how much sense they make for you as a trader, right? So what do you do instead? Of course, there's complex trust structures you can use if you're really big, right? But most people aren't really big, right? Maybe you're making, I don't know, a few $100,000 a year or something off your trading activity. Maybe, in a good year you make $1 million or something like that, but you're not routinely pulling down $5 million a year or something like that, right? Okay. So in this scenario, it pays to go, of course, to a place that has just straight low personal tax, okay? So where would these places be? Well, I'm here in UAE, zero tax, that's perfect, right? If you can go to some place like Monaco would make perfect sense. Some place like, one of these Caribbean islands, if you want to go there, that can make perfect sense. If you are maybe not interested in those places, then you can start saying, okay, well, maybe there's some other options. So for example, this is where a place like Bulgaria or Montenegro can pay off, because you're in a situation where Bulgaria, okay, it's not zero tax, but you can pay 10% tax or lower. So that's pretty good, right? You're like, all right, a lot better than the 45% that I'm going to pay in UK, or 50+% I'm going to pay in a bunch of other parts of the world. So that's like where you start to make sense of some of these lower tax places. So some potential options. Possibly there's some things you can do in a place like Georgia. You can do some things with Bulgaria. You can do some things with Montenegro. You can do things with sort of, to some extent, Thailand. Thailand's like kind of a weird place, but you can maybe make something work there. Like I said, UAE, certainly Monaco, certainly Bahamas, Cayman Islands, Antigua, St. Kitts, all those types of countries, right? There's things you can do in those parts of the world. Where else could you go? You could possibly, if you're going to go to some of the other Middle Eastern countries, okay, maybe there's some options there. But there's also some of the other Eastern European countries that you can get fairly okay. Usually not quite as good, but as an example, Macedonia would be in there, or Northern Macedonia, I guess we should call it by its proper name. So some of those types of countries. So I guess the bottom line is, if you're somebody who is a trader, I would throw it into kind of three camps, okay? Number one, the traditional zero tax countries. Number two, the not zero tax but low tax countries like Bulgaria. Mostly these are, I would say, Eastern European. There's a few in Latin America, that kind of place. The third thing that you could look at doing, if you're making enough money, is you could go for some of these flat tax programs. So for example, Greece has it's 100,000 euros a year. This is fairly high. But on the other hand, if you're making $2 million in a year, well, that's 5%. 5% pretty reasonable. Maybe you prefer living in Greece to someplace like Bulgaria or one of these others. Likewise, Italy has kind of a flat tax program that you can do. So again, maybe you would prefer to go there. Maybe you want to do something, one of those. So that would be my general advice for you, just depending on your tax bracket. I'd probably, if it was me, go to UAE just because it's clean and easy and things like that. But it's really a decision for you based on kind of your values and what works well. Like I said, if you have enough scale and you don't want to leave your home country, there may be a possibility that you can use some sort of a foreign trust structure, and you won't be able to take that money back to you personally, right? But you can maybe still defer it and kind of grow the money as you trade it abroad. And basically how that would work is this. You have an international trust which owns a company, and you're essentially contracted to that company to provide services of trading and managing this foreign portfolio. And any funds that are paid out to you would be taxable to you, but it might be possible to defer the actual base income. Now, there's lots of nuances to that. Trusts are super complicated, and some countries don't have trust laws. So you have to figure out how to navigate it, but that would, generally speaking, be a way to go. However, keep in mind, you're going to have to pay a bunch of fees to maintain that structure, and so that's kind of an effective tax. So for you to make enough that it would make sense, that depends on you. And because you're ultimately going to have to pay tax when you get it back, although the deferral could have a lot of value, especially if you're able to compound your money very quickly, it's best suited if you're then able to leave the country in the future. You're like, okay, I'm going to move away in 5 years when the kids graduate or something, and then you can realize those gains. That's kind of your optimal scenario. So anyway, I hope that helps. If you have any questions about it, please reach out to me. You can put a comment below, or book a call. Again, calendly.com/Michael-Rosmer, link in the description below. If you like the video, give us a thumbs up, share it with your friends, hit the subscribe button, nail the notification bell. Really appreciate your support, and I'm going to look forward to seeing you guys on the next video.